Thank you very much, Joe. And absolutely, I think it's very important to understand and go through the reasons why somebody would do a merger like that. I even can speak for Sandstorm as a company that has about $800 million market cap, and we trade around $7 million in shares per day. We still do struggle to gain the attention of institutional investment out of the U.S. And so it's important to really kind of think about how that size affects you. And certainly that was part of what they were going through. So after I get through the cautionary note here, I think everybody here probably understands how royalty and streaming companies work. But for us, I think despite the fact for Sandstorm that it's been around for some time, we've changed quite a bit. But we have always kept a focus on really what's important to creating proper value in a royalty and stream. And that's really that exploration success and demonstrating that value, optionality value in your assets. And for us, I think we've done that better than anybody else, and we provide not only that risk-adjusted return, but that great bit of optionality that helps you really get a leg up on what's going on in the market once the market turns around and people start looking at gold in a different way. So for us, I know this looks a little bit misleading. It looks like we don't have a lot of growth in the next couple of years, but we went from 60,000 ounces of production last year, going up to over 70,000 this year. But eventually, once we kind of get one of our big projects underway, going up to over 140,000 ounces by 2023. This is really just kind of a split out of the cash flow of each of the individual assets. Each of those columns represents the sections within it, represents the cash flow that we get from each one of these assets. So we are, and we have been very diversified. Typically, we've used that as a way of trying to protect ourselves. You can see really that one very large bit that comes on, and that's this prime asset, Hod Maden. Unfortunately, I won't get too much of a chance to talk about today, but if you're going to dedicate yourself to that much of your NAV to a single asset, it better be a good one. And that's what we feel about Hod Maden. Just really based on our track record, for us, I think we've done a good job of growing the company over the years. Every year we've produced more ounces than we have previously. Almost every year, despite the fluctuations in gold price, we've had higher revenues. But most importantly is really this aspect. Is this aspect of really that growth in assets. We've done the best in terms of really taking advantage not only of getting good deals on the cash flowing assets, but loading up on that optionality, which I think is that very critical and very low cost element that has been present in the market for the last 4 years now almost. So I talked a little bit about that big asset, Hod Maden. For us, this was a little bit of departure of really what a normal royalty or stream looks like. But we felt it was really worth it. This asset is located in Turkey. It's up in the northeast corner, very close to the Georgian border. It's an asset in a very good jurisdiction. We are a minority partner in this. A local Turkish partner who is also partners with other Canadian companies and an operator in Turkey is the one that's going to be really ultimately designing and building this asset. We ended up picking this project up in 2017. And what we like so much about this asset ultimately is really the high grades that come out of the asset. It has a million-ton core to this asset that runs over 33 grams. And that's not a narrow or a small one. It's about 30 or 40 meters wide. It's about 400 meters deep. Around that, there's a framework of material that's 10 to 30 to 33 grams material. That's another almost 3 million tons on top of that. There's a lot of exploration that can be done on this, and a lot that more that this project will likely grow. We've entered into some of the initial economic studies of this asset. We feel the timeline that you see up here is fairly representative of where we think this project will go. It's not a difficult project. It's near the surface. It's in an area where there's, in fact, power lines, 2 high voltage power lines that go right over top of the asset. There's a paved road that goes almost directly up to the project, and it's one of the areas that's had more infrastructure of Turkey that's had more infrastructure spending than anywhere else. And this really kind of comes down to, I think, where you look at it and how it fits into most of the projects out there, if you're just going to look at it from a very high level. And that's really just looking at what we expect the costs to be on this. So this is supposed to be an all-in sustaining cost for the asset over its 11-year mine life. So on a co-product basis, just on the gold, it's $374 per ounce. But on a byproduct basis, if you were to take the copper that's being produced in that copper con, there's just one concentrate coming out of there. If you were to apply that to the cost of the gold, you'd be producing gold for less than $100 per ounce. And this is really how it fits in with, I think, a lot of well-known assets in the industry today. But now really going back to, and including Hod Maden, I mean, what we strongly believe in is that the upside and the real strength of the streaming and royalty space is the amount of exploration upside you get on these projects. Some of our first projects, the original projects that we got involved in, call it Santa Elena, Arizona. These are all projects that originally had mine lives of 6 to 7 years. Santa Elena has been continuously in production since 2010, and it still has an 8-year mine life ahead of it. Arizona is the key asset underneath the Equinox company, and it's going back into production. We've already made a tremendous amount of cash flow off of that asset and sold some assets. But for us, the real key is that exploration upside. And what that means is you get to get attached to projects that are going to get a tremendous amount of drilling on them. And for us, this shows the amount of drilling that has occurred on our projects over time. And these are really valid projects. This year's project total is going to end up being closer to 700,000 meters drilling. And those are assets like Hyundai, like Cerro Moro, like Arizona, assets that are producing today. Those drill holes and these meters that are drilled in 2015, 2016, 2017, that will translate into cash flow from ounces today. And we also have these massive land packages associated with these projects. Cerro Moro, just the asset, the concessions that our stream is on, is 2,000 square kilometers. We have an area of interest outside of that that expands it to almost double that size. And then the same thing with Hyundai and Chapada. These are all projects that have had $6 to $10 million in exploration budgets on them this year, and they'll have the same amount of budgets next year. I think it's pertinent to really kind of understand where we fit in this whole curve and how we compare to our peers. This illustrates, I think, the EV to EBITDAs for all of our peers in the group. All of us do have a fairly good growth profile for the next 2 years, but I don't think what people realize is just how much stronger our growth profile is over time. And the way I think we look at it is because we've built that good exploration upside, because we have that good base of assets and those good partners going forward. If we were just to sit on our hands and just accumulate cash, we can't be trading at this valuation over the next several years. So we're determined, Nolan and I and the rest of the management team, to be able to make sure that we just don't screw things up. And the way we've analyzed them, the way we believe we do that, is by really following this curve. So I'll just quickly explain. This is price to NAV multiple on this side. And then along the horizontal, this is percentage of total assets that are cash flowing today. So you can see up in this top corner, the Francos and Royals and Wheatons of the world, most of their assets are in production today. Because of Hod Maden, because of a number of these assets, in 2018, we're trading down here at this discount to NAV, but because a large portion of these are we're in the development stage. When you fast forward just to 2019, you can see a distinct change already with Cerro Moro and Arizona coming online, 2 big, long development projects we've had. That starts to move us up this curve. By the time Hod Maden goes up the curve, we look at that. But the point of this is that for us, any capital that we want to deploy from this point onwards, we want for it just to be able to push us up that line. And that's really exampled, and that's proven, and I think shown by our acquisition just this morning announced on Fruta del Norte. Fruta del Norte should be in production by Q4 of this year. We'll start be receiving over $3 million in cash flow from that royalty on an annual basis, and that should help push us up this line as well. So that's really, I think, the crux of what we're talking about, is that the deals that we're doing from this point onwards are going to be focused on cash flow. But in the meantime, we still have this huge batch of optionality in the background that will provide and will go up and provide some value to us in the future once the gold market starts turning around. And so I think with that, I will pass it off to Joe again, or on to Patty.